Hi, good afternoon. I'm Jimmy. I'm honored to be here to share some personal thoughts, observations, and perspective on BTC mining. And the heart of mining business is profitability. It is about revenue minus electricity and operational costs. That's simple. It's a really simple equation. But the story behind it is complex. I will do my best to break it down. First, we will look at how the 2024 halving has shaped the revenue and transaction fees. Then see how renewable energy and AI are helping miners keep costs down and efficiency up. Let's dive in. The 2024 halving hits in April. Half the block reward with nearly 95% of Bitcoin already mined. You'd think profits would take a dive. That's not exactly true. Let's see some numbers. In Q4 2023, miner earned 3.6 billion, which is the same as it in Q4 2024 and Q1 2025. Although there was some fluctuation in between, in general, the miner revenue is remaining on the same level. Let's see hash rate. It's jumped about 50% from 600 to 900 ehash during the same period. So the year of 2024, the resilience shows miners can adapt to reward cuts through scale, which means adopting more miners or updating them into higher performance versions. Those smaller miners might not find it so easy. If we look into it a bit more, Q3 2024 projected a dip to 550 ehash, but recently, in early April, we are at a new all-time high. That quick recovery hints significant infra investment, underlying a solid base of what is ahead. Big miners are leading the charge. Mining giants Q4 2024 mined 703 blocks, which almost doubles the number in Q1 2024 pre-halving. And even more, its net income grew about 6% from Q1 to Q4. And nevertheless, another giant pulled in 143 million in Q4 self-mining, 377 million for the year of 2024, with hash rate up to 154% yearly. I just want to recap. At the same time, the network hash rate only rose about 50%. Scale was paying off for them. The halving was not disrupted the short-term profit model for the giants, but it widens the gap with smaller operations. For those smaller miners, high power costs and outdated gear pushed many out in Q4, and that's likely to continue into 2025. As our recent talk with some miners, the mining industry is becoming well capitalized, more regularized, and mature. The economy of scale is necessary for splitting the fixed cost per unit. Consolidation would be a trend we might see deepen this year. That split suggests a more centralized industry over time, which isn't without risk. There has been a lot of talk about hash rate centralization and the network security worries. But in my personal view, there is a lack of economic incentive for the large miners to attack the network as their long-term cash cow. Here is a humble truth. With less than 5% of Bitcoin left to mine, block rewards won't carry us forever. So transaction fees are where the future lies. Let's take a closer look at how they are doing. Fees after halving, a bit of roller coaster. It dropped from 5% of mining revenue in Q4 to 1.33% in Q1 2025, and even more. It peaked at 72% during the April halving and then fell, echoing big but fleeting spike from 2017 and 2021. Those surges show fee can cushion reward cut briefly, but their ups and downs mean we need something steadier. Daily fee tell us the same story. It reaches more than 100 BTC daily in April and August 2024 and dropped to single digits recently. It's a really big drop. And what's driving this? Of course, halving is one of the biggest reasons. But what's more? Let's see some facts. As someone mentioned ruins before, ruins kicked off with 135 million in its first week of April 2024, lifting in the second half of the year, though it's tapering off now, and Ordinals added 200 million in Q4, but its share shrank in Q1 as speculation cooled. Those booms are exciting, but their short lifespan pushes us to find lasting solutions. Yes, speculation fueled Q4's high and the ruins and ore, but the drop-off shows is limited. And as we all can see, speculations, FOMO, and meme are always around, popping up at different times in different ways and growing fast on various blockchains. But clearly, these aren't a steady source of fees. So what could provide steady fees? I see layer 2 solutions, tokenizations, and real uses that can create solid value for the long run. And let's start with the layer 2 network. The Lightning Network has demonstrated robust growth in transaction volume, rising from 12 million monthly in August 2020 to 78 million in 2023 and 286 million in November 2024, reflecting its increased adopting as a scalable Bitcoin payment solution. In 2025, daily transaction estimates suggest about 200K transactions with volumes potential reaching 10 million per day, driven by efficiency gains and user cases. Despite stabilizing capacity in early 2025, the network ability to handle higher throughput with fewer channels highlights its mature infrastructure and the promising future for fast, low-cost Bitcoin transactions. And then the tokenization is gaining traction. Digitalizing assets like real estate and bonds with both traditional finance and the DeFi tapping into its potential for seamless access and trading. Bitcoin stands out for tokenization due to its unmatchable security and the highest hash rate, plus its 1.6 trillion market cap, making it a rock-solid anchor over less proven chains. These strengths could surcharge Bitcoin's role, bleeding its trust stability with tokenization's flexibility, positioning it as a prime choice for a tokenized future. Further, let's see some corporate adoption cases. As we all know, the MSTR's massive stash of about 500K BTC underscore Bitcoin's growing role in corporate treasury, proving it is more than just a speculative asset. While Tesla's nearly 10K BTC holding haven't yet been translated into daily transactions, their past engagement, like accepting Bitcoin payment in 2021, shows how big players could drive real-world use, potentially sparking millions of trades if they fully commit. These examples hint at Bitcoin's mainstream potential, where corporate adoption could fuel widespread activity and cements its place in everyday finance. Let me share one example that caught my eye, which is CKB. It shows a complete chain of payment from infra to interface. It's a layer 2 solution with wallets for payment. It's using Stable++, RGB++ for stablecoin flow across chains, and Fiber Network and CKB for fast off-chain processing and settlement. And a sell model for smart contracts pairs that with Bitcoin security, and it's a standout payment infra. Think e-commerce or cross-border payments, lifting chain activity. CKB's framework feels like blueprint for how layer 2 could stabilize and scale fees. Together, these ideas could enrich Bitcoin ecosystem, more volume, more value, more fees. It's a hopeful picture if we can make it work. with halving Titan revenue, let's shift to how renewable energy and AI can keep mining viable, cutting costs, boosting efficiency, and tackling environmental pushbacks. Firstly, renewables are changing the game. By 2025, 56% of mining runs on clean energy, up from 37% in 2021, and Texas miners tap wind, 30% of state's power, and solar at just 3% per kilowatt hour. That's cheap. That's really cheap. And green power gives them a cost edge, keeping profits alive as rewards shrink. A leading mining company's solar project in 2024 also cut costs to only 4 cents per kilowatt hour and cut emission by 6%. And further, there is a synergy between miners and the local electricity facilities and network. Bitcoin miners can work with the electricity network by soaking up excess power during low demand period, like overnight or wind days, and keeping costs low while supporting grid stability. When demand spikes, such as like the Texas heat waves, they quickly shut off, freeing up energy for homes and earning profits in the process. As the innovative heat reuse offers another twist, Bitmain's NRAC redirects 290 kilowatt miners heat to the hotel swimming pool, saving about 200 heating costs daily, and also add on 200 daily mining profit. This clever approach not only saves money but also trim carbon emission, a surprising win-win. As energy-intensive industry, you may be interested in mining's carbon footprint. It accounts for just 0.2% of global carbon emissions, and renewables shrink that further. This counters eco-critics' argument. It's try to see miners transform a challenge into an opportunity with such ingenuity. And AI is another piece I find fascinating. AI enhances Bitcoin mining by optimizing efficiency, reduce downtime, extending equipment life, and improving sustainability. As seen with companies where it fine-tunes hash rate power use to maximize output per watt. According to some research, it cuts downtime by up to 30% using predictive maintenance to spot failures in rigs before they crash, keep more miners online and boosting profits. AI also extends equipment life by catching wear early to delay cost replacement, a big deal of pricey ASICs. In short, AI gives mining operation a smart edge, high efficiency, lower cost, and a greener footprint. So, where does this leave us? Renewable energy keeps mining affordable and green. AI sharpens operations from energy to revenue. Together, they are helping miners not just survive the halving, but thrive. It's a humbling reminder of how innovation can shift the odds. Here's my take. Mining is handing its tone now, but Fin is layer 2 and mass adoption to shine long term. Renewable and AI as the unsung heroes keeping costs in check. Bitcoin mining evolving, and I'm excited to see where it goes. Thanks so much. Yeah, that's it.